Anytime an economic slowdown and a housing downturn appear in the scenery, there are questions about the next global financial crisis. That's a bitter aftertaste from the last global financial crisis. So now housing has entered a downturn in some of the most inflated markets: Sydney, Melbourne, London, Hong Kong, Vancouver, Toronto, Seattle, San Francisco, Silicon Valley, and so on. The list keeps growing bit by bit. Manufacturing at a global level is slowing down too. In China, Germany, and Japan, manufacturing has started to shrink a tad. Those are the three largest exporters. In the US, manufacturing is still growing, but the pace of growth is slowing. Korea and Taiwan are also experiencing downturns in the manufacturing sectors. These 6 countries combined account for about 2/3 of global manufacturing value added. But other countries such as Mexico, Brazil, and India are experiencing growth in manufacturing that is accelerating. If the U.S. manufacturing sector, the second largest in the world behind China, also enters a downturn, it will turn into a global manufacturing recession. These happen. But services are still strong. Services include finance, insurance, healthcare, and rents. Services account for the vast majority of a modern economy. Job losses aren't skyrocketing. Companies are still hiring. Big banks haven't collapsed. So at this point, we might approach a global manufacturing recession and a market-by-market housing decline. But because of the service sector, we're some distance from a global recession, though individual countries such as Italy and Germany may already be in a recession. Services, too, might eventually stall, and then a broader recession takes place, which will exacerbate the housing downturn, and then banks will start taking losses that will eat up their capital, and some of the banks will begin to teeter. So will this lead to another global financial crisis? And will China be the epicenter? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's Sunday, March 3rd, 2019. Financial crisis is a rubbery term that can be stretched in many directions. For our purposes, a recession, even a steep recession, or a stock market crash is not a financial crisis. They are more or less routine occurrences in the business cycle, or the credit cycle as it's called. In a recession, companies default on their debts that have become too burdensome and go bankrupt and shed their debts. Zombie companies are liquidated, thereby making room for healthy competitors to thrive. Bankruptcy courts will be busy cleaning up the mess. Law firms, bankruptcy advisories, and investors that buy assets at fire sales will be making a killing. Other investors take a big licking, but that's a risk they got paid to take. A normal recession lasts a few quarters. Afterwards, the surviving businesses are stronger, the economy is less leveraged, and emerges with much of the debt burden off its shoulders. It can then grow more vibrantly. Think of a recession as the cleansing process in the business cycle, or the credit cycle at investors' expense. But a financial crisis is decidedly not part of the credit cycle. Financial crises are often related to a banking crisis, when credit freezes up, when companies or governments suddenly can no longer borrow enough money to service their existing debts and meet obligations and fund operating expenses and stay afloat. There is an element of financial panic in a financial crisis. Financial crises involve all kinds of problems, including deep recessions, widespread asset price crashes, markets with no liquidity, defaults of healthy companies that are suddenly cut off from daily funding, and the like. In emerging market economies, financial crises usually involve a currency crisis and fears that the government will default on its foreign currency debts. Government funding dries up and the economy spirals down. There have been many financial crises, but there has been only one financial crisis in my lifetime that had a long-lasting and deep global impact, the big one, made in the USA, the global financial crisis. The other more or less recent financial crises only caused some ripples in distant financial markets, though all of them caused hardship and pain in the region where they occurred. Here are some of the recent examples. 2018, the Argentine financial crisis, a currency and dollar debt crisis, along with an economic and inflation crisis. The IMF is on top of this one with a massive bailout package for the foreign currency bondholders. 2014, the Russian financial crisis, which included a currency crisis and a banking crisis that resulted in the collapse and winding down of some banks. From 2010 and lasting for many years, the Greek financial crisis that consisted of a government debt crisis, government default, and haircut for holders of government bonds, the collapse and bailout of banks, and the deep economic crisis. 2008 through 2011, the Icelandic financial crisis. 1999 through 2002, the prior Argentine financial crisis. 1998, the prior Russian financial crisis. 1997-98, the Asian financial crisis. 1994-95, the Mexican financial crisis, the so-called tequila crisis. So financial crises happen all the time. A financial crisis is generally limited in impact to the area where it occurs unless the economy where it takes place is very large and very interlaced with the rest of the world. The financial crisis in the U.S. was an event when credit froze up in a credit-dependent economy and big banks were collapsing as asset prices plunged. It was accompanied by a proper financial panic. It became the global financial crisis because the U.S. economy and banking system are so massive and because U.S. investment products, assets, and speculative bets are scattered far and wide around the world. In my lifetime, there has been only one big one. The so-called emergency policies instituted by the Fed to unfreeze credit included an alphabet soup of acronyms along with bilateral currency swap agreements with foreign central banks. While most of these so-called emergency policies have long been put back in the box, two of them endured for many years, QE and zero interest rate policy. These efforts to deal with the big one left behind a changed world, and the consequences of how the big one was dealt with will dog the U.S. economy and its stakeholders for years to come. But the policies also showed how a big country with a complex financial sector that is collapsing can deal with a financial crisis. So we will get some smaller financial crises. Australia is primed for one. Canada is two. They both have hugely overinflated housing markets in the biggest metros that are now deflating. They both have a very concentrated banking sector that is very exposed to mortgages. Their households are among the most indebted in the world when compared to their incomes. If housing declines in small increments in an orderly manner spread over many years, a proper financial crisis can likely be dodged. A crisis is a sudden event, so if confidence in the banking system suddenly falters, voila, a financial crisis. But the Australian and Canadian economies are not large enough and not interlaced enough with the rest of the world to spread a financial crisis around the world. The central banks in those countries will get this under control eventually, and the consequences might leave some ripples in financial markets elsewhere, but it'll blow over. A financial crisis in Japan would rattle the world a little more severely. And the biggie, if a financial crisis breaks loose in China, it will have global ramifications, though on a smaller scale than the U.S. financial crisis, since Chinese bonds and other assets and risky bets are not nearly as globally distributed as those originating in the United States. But what are the chances of a proper financial crisis in China? China is somewhat special. The government controls nearly everything, including the central bank, the big four state-owned banks, which are the largest banks in the world, most of the largest companies, the media and communications, etc. So it controls the money, the lenders, the borrowers, the markets, and the message. It has tools that more market-based economies don't have. It can tell the media what content they should produce, and it will be upbeat. Wayward media outlets that try to poke holes into the propaganda will be shut down. The Chinese government can just order the big four state-owned banks to lend more and turn bad loans into equity and forget them. It can order state-owned asset managers and so-called bad banks to buy bad loans from commercial banks. And it can order the big companies that it controls to not lay off people, and it can order the state-controlled banks to keep funding the state-controlled companies despite huge losses and an inability to ever pay back those loans. The government can impose limits on stock market selling. It can bail out investors in risky schemes that have blown up, including regular folks chasing after the latest crazy bet. When enough of these stiffed regular folks start amassing in the streets of Beijing to protest the results of the latest mass scam that's fallen for, the government, fearing social unrest, steps in and takes care of it. The government can bail out bondholders, no problem. These are all things the government has done in the past and more. And the government now has the eye on the debt that has been piling up at every level, including the so-called hidden debt among regional and local governments that the central government is now trying to figure out how to account for. This debt has funded years of economic expansion and huge projects and gorgeous but now empty shopping malls. It funded the cash-burning operations of zombie companies that weren't allowed to fail. It funded a million things, some of them productive, others not. But since the government controls the central bank and the big four banks, along with pension funds and other asset managers, it has very tight control over the credit markets, and it controls the currency. It can also control the message, and what the public sees about the crisis is what the government decides it should see. So China might be able to prevent a financial crisis, and it is currently full-time engaged doing just that. But it cannot prevent forever its economy from bogging down. It can prevent it for a while through various stimulus programs, but stimulus programs just turn into malinvestment and waste after a while and fail to stimulate anything. You can force a real economy to grow for only so long, and then it's stuffed to the gills with malinvestments, zombie companies, zombie banks, and over-indebted regional and local governments, over-indebted consumers and businesses, and things just bog down and are waiting for a reset of some sort. So what we may see in China may not be a classic financial crisis of the type generated in the US that spreads around the world. It may be a different creature, something we haven't seen on that scale before, something that will surprise us, as real crises usually do. And it might not be pretty. And this creature might spread its tentacles across the globe, but likely in other ways than a financial crisis. Meanwhile, we will continue to get smaller financial crises in other countries, but the impact will be mostly limited to the economies where they occur. And the US just had a financial crisis, the big one, and has changed as a result. There will be sell-offs and a recession, and the normal things that arise during the business cycle. But another once-in-a-lifetime big one of the type we just had a decade ago is not on the horizon. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.